Hi, everyone. Welcome back to The Big Picture. I'm Joe Cruy at Paradigm alongside Greg Magadini at Amberdata and Marty, Crypto Vol Portfolio Manager, trader, and legendary Twitter personality. And today, we also have a pretty legendary Twitter personality / colleague of Greg at Gravity Sucks, or Fabio Background, as you can call him. Works with Greg at Amberdata. And Fabio, I think you were one of the first guests on The Big Picture way back at the beginning of the year. I think Greg was on that podcast as well. So very pumped to have you back. A lot has changed over the past 9 months or so. So excited to have you back on, man.
Thank you. Appreciate it.
Cool. But before we begin, we have an important announcement here at Paradigm. So Paradigm and our existing partner Bybit are introducing a pretty juicy deal to offer a significant reduction in trading fees. And you can see that on the screen. If you complete just one Bybit option trade, just one via Paradigm of any size, you're going to qualify for Bybit's Pro 5 fee rate across all products. So perps, spots, and options until October 11th. Additionally, if you achieve $10 million notional in Bybit option taker volume through Paradigm by this same date, you are going to be eligible for an extended discount fee period. So reach out to your Bybit rep for more details on this extended discount. And effectively, this fee promotion between Bybit and Paradigm underscores our commitment to providing sophisticated trading tools and platforms for institutions focused on the crypto derivative space. So don't miss out on this opportunity for lower fees. We know a lot of our viewers are big institutional traders. So literally just do one trade on Paradigm in Bybit options and you get these crazy fees for the next couple of weeks. That's the TLDR. So act quickly to take advantage while the offer is live. So moving on from the promotion. So Fabio, thanks for coming back on the channel, man. And for our viewers, if you could just give a quick background on, yourself, how you got into the crypto space and what you're doing with Greg over at Amberdata.
Yeah, sure. I have a formal background in statistics, economics, but I always been passionate about trading. Mainly, I like numbers, so I started to have a trading hobby during the early days at my career. I work in other sector, but I continue to grow and to learn about trading. And in mid 2000, actually 2005 and 7, I can't remember exactly, I read a book from Nassim Taleb, Fooled by Randomness, and is one of the book of my life because it changed the way I look at the risk. So since there, I dig into options trading. So I started to study the theory behind and try to apply some trading in the equities market. And also, I've always been interested in maximum freedom. So I'm reading everything about Austrian economics and anarcho-capitalism in general. And in 2013, basically, a friend of mine in the circle of anarcho-capitalism talked me about Bitcoin. And I first bought my Bitcoin early in 2013. And since there is my passion on crypto market, I switched from trading option from equity to options crypto market in 2019. So as is there, I met Greg, I met Anand from Paradigm during the early days, basically 2020, and now I'm here, happy at Amberdata. I'm data scientist. I work with Greg in the derivatives team, basically, and we developed the tool for traders that want to have a look at derivatives market, especially options. But recently we start to expand our offering in the future sector. So this is my background, and what I'm doing right now is basically data scientist and researcher at Amberdata, and continue trading options on my part-time free time. So
Awesome. Yeah, thanks for that background. Again, really helpful for our viewers.
Sure.
So, I mean, I imagine you guys, both Fabio and Greg, you guys probably have you guys are starting to think about your quarterly report, which is awesome, by the way. We'll definitely show that on the channel once it comes out. But in terms of like things that you're specifically looking at right now, Fabio, or things that you find interesting, be happy for you to take us through it. I know you sent us this Dealer Gamma profile chart, for example.
Yeah, and Greg, you want to take it?
Yeah, I'll talk about the first two charts, and then Fabio's got some really, really good insights after that on the next three slides. So just kind of a quick reminder for people new to sort of our tools, we created loosely Dealer Gamma profiles. So this chart essentially shows us sort of the net gamma rebalancing from a 1% change in the underlying, and the y-axis is in millions of dollars. So what we can see here is kind of before the SVB banking crisis, the range of the rebalancing needs for dealers was relatively tight. And then once we had the SVB banking crisis, which was really kind of a nice catalyst for Bitcoin, and it really showed sort of the value prop of getting your money outside of the system, so to speak. And so we've seen a lot of optionality being bought by the street and dealers being net short big amounts. And then really that peaked out in the June expiration of this year, the second quarterly expiration, where we had sort of max negative gamma, and it was also sort of the biggest expiration cycle on Deribit, so that also helped out a lot. So that's something that's really interesting. But what's even more interesting is looking at this dealer profile and then comparing it to the next slide, to the Ethereum dealer profile. And again, here, so we can see, we can see like a perfectly sort of, not perfect, but it's like an inverse image where dealers are net short optionality on Bitcoin, but then they're net long optionality on ETH. And then when did this really start? Well, this really started on the Shanghai upgrade. So once people could start pulling out their staked funds from the Beacon chain, it became a lot less risky to basically own ETH and stake it, because you could change your mind and get your liquidity out if you wanted to later. And so what we've seen is, my thesis is essentially that people are staking ETH and then selling ETH options against it, the yield machine, as I like to call it, and essentially making yield on both sides of it. And so now what we've seen is dealers are net long a lot of optionality, and that has been persistent. And just like in Bitcoin, where we've seen a small sort of range of dealer positioning earlier in the sort of past 8 months, or for April, now we've seen an expanded range of dealer positioning as well. So the flows are not only unidirectional, but the magnitude is big as well. So that's something that's really interesting.
Right. So the Shanghai upgrade, so the move to proof of stake and then subsequently the Shanghai upgrade has transformed Ethereum even more so into this yield asset. I mean, we've talked at length around like this overwriter and the amount of vol supply, and you know that all that vol supply has basically translated into dealers being long gamma. Is that correct?
Yep, that's right.
I think that retail or pro-tail crypto Twitter got a little lost and confused on what long dealer gamma meant. Maybe Greg or Fabio, if you want to take 10 seconds to...
Yeah, sure. So essentially, you could think of just gamma as optionality. Essentially, it's, you know, how quickly does your delta change? And so that's a good proxy for the rebalancing efforts that dealers or market makers need to do. So kind of big picture, market makers typically are going to be delta neutral. They're going to be hedging their book. And so if they're long options, as the market rallies, they have hedging activities that tamps down the volatility because convexity is on their side. And when dealers are short, or market makers, dealers and market makers are sort of the same word. When dealers are short, their hedging activities exacerbate volatility because convexity is against them. So they're basically selling when the market's falling and buying when the market's rallying. And so that's really main hedging activity on the underlying volatility. And Fabio will talk about how does that translate into the market on the next slides.
Sweet.
Yeah.
Thank you, Greg.
Yeah. Basically what we see here is the same chart before, but with a dynamic price change. So we calculate gamma for each price in a range of the strikes and valorized all the open interest, net open interest of dealers. So this is the chart we are looking for BTC since the very start of this year. Basically, almost negative gamma dealers from negative inventory from dealers, and it depends on really on inspiration. On quarterly is increase in negativity, but usually is a constant negative through all the years, and is reflective from the flow we have seen in the recent months, where the upside convexity has been both from traders, from market participants. So the other side was the market maker that got that in negative inventory for gamma. And this is a completely different story from it with the next chart, where we've seen in the recent months, in the past months, the constant selling flow from market participants. So dealers are increasing the inventory of for positive gamma. So this impact, in our view, this impact in a practical way, the way dealers are hedging their book, because every upside movement, for example, in it gives the opportunity for dealers to sell delta accumulated during the movement, like we saw recently. And for BTC, is quite the opposite. They need to stay delta neutral. That is, of course, supposition. For stay delta neutral, they have to buy the upside move in the delta market. So these two components, and this is the next chart we just recently launched in our GUI, and it's very interesting because perfect. It's very interesting. This is the cumulated funding rate in looking only at Deribit for BTC perpetual and ETH perpetual, coins marginated basically. So we see that until mid 11th of September, there is no divergence basically between the two funding rates, meaning that the usual variables that are affecting the funding rates of the two coins are basically the variables of a normal market. But since 11 September, if we think at the realized spot movement we seen from that, so there was a big upside movement. So the thesis that BTC funding goes positive, went positive, and ETH funding went negative is confirmed by our gamma profile, because during the movement up, dealers, for hedging the inventory, needed to buy the futures, and the opposite for the ETH inventory. So we are received a lot of criticism about the gamma profile, because they're saying, no, there is this hypothesis, the market or the options market is still little, it doesn't affect anything in the wider spot market or futures market. That is true. It's currently not so big to have an impact on the broader market. But if we see only the interconnecting ecosystem of Deribit, for example, supposing that the hedge and flow goes into the Deribit, we are seeing some interesting correlation between our gamma profile and, for example, the founder rate. Another example is the general open interest. It's quite interesting, for example, that the open interest of swaps of perpetual for ETH is higher than the BTC perpetual on Deribit. This is very unusual for other exchanges and other futures expiration. And this is another clue that gamma profile could have an impact on other metrics within the ecosystem of Deribit. Currently, we are working a lot developing this thesis. There are missing pieces we want to put in the analysis, but this is, in my opinion, very interesting and very promising for a backtesting, future analysis, and so on, maybe for the next quarterly report.
Interesting. So the gamma profiles are translating into this divergence of funding rates. But you made a point, which I, definitely at least partially agree with you on, that, crypto option markets are still so small, right? And when you look at the option volumes relative to spot volumes or the futures volumes, in equity options and in other asset classes, you always talk about these, gamma feedback loops. So you guys have the belief that just because the crypto option market is still so small, it's not really something yet that really has the potential to drive the actual underlying price movement in either direction. Is that correct?
Correct.
Cool. Yeah. I think that makes sense.
We calculated that with the maximum hedging flow we have seen in the recent months in a quarterly expiration is around a tenth of the magnitude it's needed in theory to move the spot market. Because, because I talked to a spot gamma guys, I can remember exactly the account on Twitter some years ago. He told me about the equity options flow hedging activity. It needs to be around 3-4% of the total notional in the spot market. So I think that 10x from here is a good spot to have some pin effect or boosting effect on the underlying market, especially during the weekends, maybe, or other low liquidity periods. I think it's something interesting to look.
Yeah, I always say that the...
Go ahead, Marty.
Right, Marty. A question for you after.
Okay, sure. Yeah, I always say that the options market is still new and small, but there's some of the smartest brains in TradFi coming over to the crypto options or the vol market. You're not seeing a lot of institutional flows here. It's mostly all going to be institutional orders at this point in time, right? When the froth comes back and when the market, October, Santa rally, whatever you want to call it, comes back, that's when you're going to see a lot of these more retail options flows. Right now, it's the smartest people in the options vol space picking up all of these orders. Just thought it was worth mentioning that.
Yeah, that's a good point. And my question for you, Marty, is like when you're running your vol book and you're going to using delta hedging and stuff like that, are you using the perps market or the futures market for that particular option? So if you have a DECE position, are you using a DECE future or are you hedging out with the perps?
Mostly on the perps. The issue with Deribit specifically is that maybe the perps market isn't as liquid as you want. So maybe you have to hedge off of Deribit and then you run into capital requirement issues and other things like that. It's easier to trade options on Bybit or OKX because the D1 liquidity is there. But then you run into the issue that there's not a lot of liquidity on the options or the spread is too wide or it's good as an option seller because you can capture that spread and maybe it's less competition than Deribit, but overall we're using perps for that.
Yeah, that makes a lot of sense. And do you have any close market maker friends that you keep in touch with and basically get some feedback on sort of sentiment of inventory?
Yeah, mostly it's all through Telegram, right? It's so funny that all the crypto vol trading kind of all goes through Telegram and then gets cleared on Paradigm, right? If you don't have an ISDA with some of the bigger guys, then maybe you can just ping them on Telegram and they'll settle through Paradigm, Deribit, Bybit, whatever you want to call it.
Fabio, and I think a point that you'll find interesting, we speak at Paradigm, of course, to all the big market makers that have pretty large, flourishing over-the-counter businesses. And what they tend to say is, their bilateral, ISDA over-the-counter flow kind of fluctuates between 40 and 60% of the overall flow. So you can kind of say, like, okay, half of the flow is listed and then half the flow is OTC. And a lot of the flow that is coming OTC, miners being one of them, who tend to be, sellers of vol, via their yield enhancement plays. And, I've spoken to dealers around positioning or, BTC Dealer Gamma in the past. And, some of the biggest players in the market have said it's just like, yes, like from a listed perspective, things in BTC can look short Gamma. But once you consider, half of the flow doesn't really even, occur on Deribit, then what they tend to say is they tend to lean, flatter Gamma / long Gamma.
Yeah, definitely could be, but since we never know the OTC,
you can't trust it. Yeah, I think it's difficult, right? I mean, I get it. But okay, interesting. Yeah. So, go on, Greg.
Real quick on that point. On that point, something that's still interesting is that even though the overall positioning from OTC flows might be different, there's two kind of still really strong insights you can get from Deribit's positioning. One is sort of the smaller trader sentiment, especially with on-screen trading, small lots, all that stuff. It's basically going to just be concentrated at Deribit. So that's pretty interesting. And then the second interesting point is that if people are trading on Deribit and they're going to manage their collateral, the effects of perp funding that Fabio just talked about still remain true. You still have to hedge out your short Gamma with some long perps or whatever it is, depending on the direction, I guess. But you kind of get what I'm saying. The margin requirements are still within the Deribit ecosystem. Now, granted, Genesis Trading probably has a gazillion dollars of margin. I mean, before they stop trading, but
yeah, maybe
for the most part, yeah, maybe. I love the Genesis guys. No heat.
I love them, but I don't want to touch anything Barry does with the 6-foot pole.
Yeah, I don't blame you. I'm not going to opine on this one. But so in terms of,
I can't cancel Marty, so it's okay.
Yeah, Marty, you are just completely uncancelable. They might. Oh, let's hope they don't suspend your Twitter again or take that away. Knock on wood.
Welcome back.
Yeah, I know. But on Paradigm, I would say, the main flow that we've been seeing this week has been, buyers of BTC Gamma ahead of the FOMC later today. So the biggest trade that we saw over the past couple of days was 1,200 of the Friday 26, 28 strangles were bought on Paradigm order books. And, it was a very patient buyer executing in small clips of, 25 lots to 50 lots, as opposed to, RFQing and taking down 100 or 200 lots, just given the amount of Gamma that's going through. And in terms of, where these were bought, kind of in the high 30s, low 40s in terms of vol versus, 10-day realized currently, I think around 35, and in premium terms costs around $200. So clearly somebody putting on a decent sized position, looking for a move ahead of the Fed later today. And by the time this episode actually airs, we'll certainly know if the trade worked out or not. But, Marty, you've always been quite vocal around, the vol crush, post large events like this. I'm curious if you're taking any positions ahead of FOMC that you're willing to talk about a little bit. Would you be selling vol at these levels? I mean, just looking at the VRP, implieds aren't trading too much higher than trailing realized.
Yeah, well, with this guy, right, is we also can't see the whole book, right? So maybe it's just like 0.001% of his whole book, and if it goes well, he cashes big. Right. In terms of JPow and all of his tools and whatever else, I think that it's mostly priced in. If anything, we get this kind of like every time, right? We get this instant spike, and everybody closes out, and then the next couple of days are fine of selling vol, and then you get into the weekend, and then the weekend's dead. Until there's like a whole regime shift or like a sentiment shift and, vols are coming back up. I don't know. For now, I just think we're at this like 30 to 50 devol range. If you're following that, that's kind of where I'm at right now. And that can stay for very, very long, right? We can just ping pong. Oh, we're back. Oh, we're screwed. We're back. We're screwed. So for now, personal positioning, I'm not selling anything. We're working on a new little project that I'm sure will be public fairly soon. And then I'd probably unwind the fund to go ahead and work on that new project.
Nice. Yeah. Fabio, were you going to say something?
No, interesting what Marty said.
And it's still crypto options related, right? It's not like I'm leaving the game forever, but I'm just done selling vol. I can't stand it anymore. Like, oh, fuck. If we go back 30 to 50, there's money to be made, but you're always going to be waiting for this crypto-specific news, like the XRP or the Grayscale or the SEC, whatever it is, and at any moment, the steamroller could come. I think I said that last episode.
Yeah,
well,
that's going to be the cap for the episode when we market this thing. Marty says, I'm done selling vol. I'm sick of it.
Yeah, I'm sick of it. And the memes, when vol is back, the memes will be amazing, but for now, it's just, you're just waiting for the steamroller. Maybe Loris was right after all. You never know, right?
Right. And Greg, there's something I wanted to bring up to you. Last week with our episode with QCP, you mentioned that on a normalized basis, the pricing of the BTC put wing was at some of the most extreme levels that we've seen this year. And since we filmed, 6 days ago, BTC spot has kind of just grinded higher a little bit, into the 27s. Of course, we had, small stints of decent upside intraday realized, but nothing crazy, right? And then you look at the skew now, right? And the skew has reverted quite a bit, where in BTC, calls are trading over puts throughout the curve now compared to last week, where it was puts trading over calls for all of 2023 expiries. And for me, that's like kind of shocking. That it reverted this quickly. I feel like the skew volatility in this asset class is just like absolutely insane. Like, I mean, around events like SVB, when we went like puts over calls, calls over puts, and like a 20 vol difference in 12 hours, that makes sense. But like when you're just talking about a grind higher and this thing is moving, like the skew is moving this significantly, like what do you make of this?
Well, I definitely agree with you that the volatility of skew itself is like one of the most interesting things about crypto. Like you can almost just trade that thing on an up and down basis. And that's it. That's a great point. The point that I was making last week was just really the idea of like how expensive the wings were relative to the belly, and then especially the put wing. I do think that is a little bit of a artifact of a low vol environment. Because if I think of like low vol, essentially, no one's going to give you like the tail risk for free. So what happens is that the tails still have to like price in the unknown unknowns. And so what happens is in a low vol environment, the belly is going to become very cheap, but the tail, although it'll have lower vol, relatively speaking, it has to trade at a higher relationship. That being said, though, and I shared last week, it looks like those wings were, pretty elevated, and that's sort of a bet that would make sense to, either put on put spread again, a short delta bias, or just like with the delta hedge put spread if you just want to talk about the delta bias. To me, that seemed very interesting. To your point today, the fact that the risk reversal is moving so much on such a relatively little move, I think that's interesting. I think another interesting point is, we're just going into FOMC, BOJ, BOE, like those are a lot of catalysts that can switch everything around. I mean, I don't think it will, but
Theoretically,
it could. So the volatility of the skew itself is very interesting. Absolutely.
Cool. All right. Well, we're at the 30-minute mark now. I had some extra stuff to share, but I'm probably just going to save it for next week. Yeah. So this, or in a couple weeks. So this episode isn't an hour long.